Hello, and welcome to another Ethical Corporation webinar. Today's webinar, ESG Data, What Should We Really Be Measuring, is a rerun of a session that we hosted at our Sustainability Reporting event in Amsterdam in October. We received so much positive feedback from the session, I wanted to host it as a webinar to further share the ideas and insights with you, today's listeners and our wider community. This is an increasingly important area within the reporting and measurement space, and through our research at Ethical Corporation, we've seen a big uplift in questions and challenges around the measurement of ESG data over the past 12 to 18 months. Most of this is due to the increasing demand from investors for more accurate and verifiable ESG data. I'm happy to say that all 5 of the expert panelists from the October event have agreed to spare their time again to be part of today's webinar. So thank you to you all. Before I hand over to today's moderator, Andrea Palmer, there's a few housekeeping rules that I'd like to raise with you first. In the second half of the webinar, we'll be having an interactive Q&A. So do ask your questions throughout the presentations, and we'll get round to as many of them as we can at the end. You can see the question submission box on the right-hand side of the webinar pop up. For those of you who are looking to share the insights across Twitter, then please do use the hashtag RBSEU. Okay, so let's get the webinar underway. It's my pleasure to hand over the reins to Andrea Palmer, the Product Specialist, Impact Equities and Bonds at Triodos Investment Management, and also the President and Founder of Net Impact Amsterdam. So Andrea, over to you.
Yes, thank you, Liam, and hello to everyone who is listening in. It's really wonderful to be here. We had a lot of fun discussing this topic back in October at the Reporting 2019 conference in Amsterdam, so it's really fantastic that we get to be able to continue it here. And it's really the million-dollar question. What should we really be measuring? For those working in sustainability at corporates or doing ESG analysis for investments, this question will probably never go away. It will just continue to evolve. And even since the last time we discussed this topic just a couple of months ago, there have already been huge progressing insights, including a final agreement on the first official EU sustainable finance taxonomy. So it's a constantly evolving field. And so our job today is to try and demystify where we are today by viewing these questions through various lenses. So first up, I would like to invite to the table Colette Grosscurt from Actium, which is an investment manager based in Holland, to share what ESG data they find meaningful and to help make more informed investment decisions and how to efficiently obtain this data from companies. So without further ado, may I turn this over to you, Colette?
Yes, definitely. Thanks a lot. And happy to be taking part in this webinar today as well. So maybe before I start my presentation, just a short explanation of who I am. I'm a responsible investment officer at ACTIAM, and ACTIAM is an impact and sustainability asset manager based in the Netherlands. And actually, sustainability is at the core of what we do. So I'm very happy to give some insights on how we use ESG data in our daily activities. Can I get my slides up? See? Yeah, thanks a lot. So maybe before zooming into the little details of ESG data, I think it's always good to take a step back of why we're all here. That is, we actually have this huge planet that we're a part of. If you can go to the next slide. I always like to stand still at this picture because it's such a beautiful, encompassing picture. And if you realize that we as human beings are only one tiny pixel on this, it's such an incredible thing to think of. But it's also such an honorable task because this planet has so many natural resources that we are dependent on. It has air, it has land, it has water. All these things are necessary for us to live. If you go to the next slide. At the same time, we see that we're part of a huge group of people. Compared to that tiny pixel that we are on this big planet Earth, we're also part of a huge group of people that is growing exponentially each year and that is using all the natural resources that we have, which actually puts us in a spot where we're facing more scarcity of natural resources. And from an asset manager perspective, that's a very exciting time to be in because on the one hand, this poses huge risks to our investments. And at the same time, it also poses a lot of opportunities that we can take part in. If you go to the next slide. And this is actually the standpoint or the starting point of all the work that we have developed over the last couple of years. We started out with a planetary boundaries framework where we look at the 9 boundaries within which human species have to operate to be able to continue living the way we do. So you can think of climate change, you can think of biodiversity, you can think of freshwater resources. These are all resources that we need and that we should not pass to a certain extent. Then next to that, we have the Sustainable Development Goals, which is another interesting framework which steers our decisions every day, because we want to move towards a world that is sustainable and that considers all the both environmental and social aspects that thrive us as human beings. And then from a financial perspective, we use the concept financial materiality, where we consider the key issues within companies and countries that they can influence and that they are dependent on. And to combining all these concepts together, we have developed a new sustainability framework, which you can see in the next slide. This is our new Actium sustainability policy, where we actually use certain buckets to define where companies are heading, whether they're heading in the right way. And the right way is a world in which we are more sustainable and in which we're transitioning towards a more sustainable practice. We start at the bottom where we see unacceptable behavior. We use a lot of ESG data to identify what kind of norms or legal requirements do companies not or do adhere to. For the non-adaptive zone, we also look at more materiality issues. So for example, for energy companies, we look at where do they source their revenues from? Is it mainly fossil fuels? And do they show any indication of moving out of that, that planetary boundary? Or do they show behavior that's actually not innovative and not moving towards a more renewable zone? And in the latter case, we say you're non-adaptive, so we do not invest in you because it's a financial risk for us as an asset manager. And then moving upwards, we see a more positive side, and we see more companies with an intent to be more sustainable across the spectrum that there is. And we use various indicators to actually put companies into these buckets that we use for our strategies. Next to screening our companies, we use ESG data for various other activities. If you can go to the next slide. We also set out our own targets as an asset manager, because we, with our investments, can steer towards certain goals. When it comes to climate change, for example, we've set a goal to reduce the greenhouse gas emissions that our portfolio generates by 30% in 2030. For water, we've defined a goal where we want to operate in a water neutral way in 2030. And for land, we've set the goal to have zero deforestation in our portfolios by 2030. And these are also measured in various ways. Where possible, we try to use impact metrics, such as carbon emissions compared to a benchmark, or water use in liters, of course. And for deforestation, we're looking into data providers there. Then on the next slides, you can see that we also use ESG data to report and to steer our investments. We've created a database with all the sustainability information that we have on companies, but also on the activities that we undertake, so the engagements and the votings that we do. And we've combined all of that information into a dashboard that we provide to our clients, because our clients actually receive more and more questions, either from their clients or from rules and regulations. So we see an increase in the need for more insights on, for example, your performance on ESG risk, but also on gaining insights on how you contribute to sustainable development goals, or how this relates to your financial performance. So all these types of information we are trying to capture in this dashboard, for example. And then if you go to the next slide. I think this is just summarizing a bit what kind of trends we see in terms of ESG data and how it's growing as a field, triggered through various trends, such as what I mentioned already, rules and regulations, including the EU taxonomy, but also social media is actually putting more and more companies in the picture, let's say. At the same time, we also see that more artificial intelligence and other types of technologies are kicking in that can actually help to structure non-structured data and to identify trends, but also intentional behavior of companies when it comes to sustainable performance. And then I'd like to end with a couple of slides very quickly on some of the dilemmas that we face in ESG data, where this slide visualizes the fact that we have such a growing field of data points, but this doesn't necessarily translate in that one information point that you need to make a decision on. So this is one of the challenges that we face, because more data does not always mean better insights or a better way of investing. So we're always looking for that one indicator that's the best to use in the end. And if you go to the next slide, one other thing to consider is always the interpretation of the data as well, and adding information to the data that you get, because yeah, there's always assumptions, or there's coverage issues, or there's definitional issues. So it's always good if you're trying to assess a company or a certain strategy to combine that with qualitative information as well. And finally, we also see a trend in moving from backward-looking information towards forward-looking information. We use both. We report on, let's say, backward-looking information. We report on our carbon footprint and our water footprint. But at the same time, we see that we're moving into a world where we're looking more towards scenarios, and we want to know what companies are moving towards in the future. So this requires more forward-looking information, which is still also very difficult to interpret, but very useful at the same time when making investment decisions for a better world. That was it from my side. Thank you.
Yeah, super. Thank you, Colette. Very, very concrete and very insightful. You touched on some really fantastic points, and actually some questions are already coming in. So maybe we could have a look at one of these ones. One, very specifically, how do you define water neutral? This is coming in from Lynn Johansson.
Very good question. It's one of the things that we've been working quite a bit on. I don't know the definition by heart. You can definitely find it on our website, but it considers several elements, amongst which is that we want to make sure that the water that's being used will be replenished, so that in the end it will be a circular way of using water, and also in such a way that it can actually be reused, so that it's not polluted anymore, but it can actually be accessed by everyone again.
Yeah, understand. Okay, well, before we move to Robert, I do want to encourage everyone to send through their questions. This is really good for an open and honest discussion, so feel welcome to send them through. So next up, we have Robert Sroka, who is the ESG Director and Ethics Officer for CEE Abris Capital, and he also teaches business ethics and investment at the Warsaw Business School. So they're active in the private equity space. So, Robert, may I turn over to you?
Thank you, Andrea, for introduction. Hi, everyone. It's great to have all of you here. I'm representing Abris Capital Partners, a private equity firm. So my presentation regarding the ESG data is from this particular point of view. Abris Capital Partners is, let's say, normal private equity. It means that we do not have dedicated impact investment fund and so on. So we invest in the Central Eastern Europe, we buy majority stakes, we invest in different sectors. And on the next slide, before I will try to answer the question, what should we really be measuring? I think it is crucial, it is important to answer two fundamental questions: why and how we should measure. Answer to those two questions allows us to give the better answer to the question what. And there are current many reasons why ESG data are so important for investors and also for companies, which is on the next slides. First of all, due to the current different business models and connected with them higher value of non-tangible assets, it is necessary to better manage these risks. Also, we see that ESG areas could cause material risks. So measuring ESG data is important from risk mitigation point of view. And secondly, if our portfolio companies, for example, have strong corporate governance, if they are attractive workplace which attract and maintain talents, if they can answer for the climate change challenges and so on, they perform better on the market and became more and more valuable for investors. So ESG data are important from value creation point of view also. And moreover, we see the customers expect such data, particularly in B2B relationship. We see increasing number of regulation concerning non-financial reporting. There is also strong pressure from investors, and we shouldn't also forget about fiduciary duty. So it easier answer the question what should we really be measuring if the investor or the company has appropriated business strategy, which is on the next slide, which is integrated with ESG strategy. Having that said that, I would like to underline that business strategy defines main goals, risk, opportunities, and also areas what allows us to indicate material ESG KPIs. I would like to ask about next slide. Now I would like to show that at Abris we have 3 years ESG strategy called ESG 2020 Universe. And this strategy is based on 3 pillars. Abris as a model ESG organization, end-to-end ESG process, and the last pillar is building a reputation on ESG thought leader. In our ESG report, which is on the next slide, you may find what we exactly do in terms of each pillar. But today, I would like to focus on core of our activity, which is investment process. This next slide, and it is easier to define both when and what should we measure if we clearly define investment process and related risk and opportunities. And on the slide, you see that ESG should be measured on each stage on investment process. We have an ESG exclusion list, we prepare risk assessment, cooperate with ESG consultants, we always do ESG due diligence as an integral part of the investment process. On the post-acquisition stage, we prepare ESG action plans for each portfolio company. We monitor the progress quarterly. In each portfolio company's ESG coordinator is in place. So effective ESG value creation, monitoring and measuring, in our case at Abris, is possible thanks to our tool called Abris ESG Scoring. And this is the answer to the question, what should we really be measuring? On the next slide, I try to describe the details of our tool. In this tool, we define 10 areas, ESG areas, which are monitoring, starting from corporate governance throughout environmental issues, HR, health and safety, product or service health and safety, human rights, marketing, anti-bribery, until data protection and cybersecurity. There are more than 350 measures on the 4 levels: exposure, management, compliance, and dedicated indicators. We should measure ESG data which allow us to show status of realization of ESG action plan, but such indicators should allow us also to see trends and create benchmarks. It is connected with measuring effectiveness, of course, and it is possible only by structured monitoring process, which is really, really crucial. And last but not least, appropriate measures should allow us to analyze correlations between our activities in portfolio companies. It means project we implement, management system we deploy, people we are hiring, and quantitative KPIs which we defined. And it is useful to base on the same measurements during the whole investment process, what show us progress from the beginning of the investment till the exit stage. On the next slide, to sum up, I would like to underline that in the whole monitoring process, we should use well-known and international recognized measures which are adjusted to the global trends. So it is good to communicate ESG using internal language for sustainable development. And the example of such language are the United Nations Sustainable Development Goals. To finalize, I would like to encourage you to visit our website and download our ESG report to see more details. Thank you very much.
Yeah, super. Thank you. Thank you very much, Robert. Extremely well done. And this is definitely presenting some very interesting questions from the audience. I'd like to have a look at one of them from Alina, and it says, how would you tackle negative messages that are difficult to communicate externally? Investors and the general public may turn away. Thus, companies only have the chance to get investments by communicating only the positive messages. And I also think it's great for you to answer this, and it's also a really positive segue into what Sabine will talk about. So Robert, do you have any perspectives on that? How do the companies that you work with balance the messaging?
Thank you. This is a really important question. And of course, we pay attention on the risk mitigation in terms of ESG and value creation. But what is important, we implemented really, I think, really good tool to identify any ESG risk. It means that we implemented whistleblowing procedures. My address to my email address is publicly available for portfolio companies and other stakeholders. So I've received in the past some negative information about our portfolio companies, which we register, notify, and then I try to resolve the issues. From time to time, I do some internal investigations. I cooperate with the whistleblowers, which can deliver us information anonymously also. So we have some tools which allows us to tackle these issues.
Yeah, understand. And I think the GRI reporting tool is also a very useful exercise, and Sabine will give more insights onto that. But giving an honest picture in that report is quite critical, and yeah, she will of course expand. Sabine is the director of corporate and stakeholder engagement at the Global Reporting Initiative, which is essentially the most widely adopted sustainability reporting standard out there. And yeah, well, I would like to hand it over to you, Sabine. Maybe you can also expand upon this question from your perspective.
Yes, thank you, Andrea. It's been a pleasure to be here today and to discuss this topic again, and even with a larger crowd than we had in Amsterdam during the conference in October. Indeed, I work for GRI, and as Andrea mentioned, GRI standards are the most widely used sustainability standards. GRI has been an independent international organization that has pioneered sustainability reporting since 1997. And what the standards really help is for organizations to better understand and communicate their impact on critical sustainability issues such as climate change, human rights, governance, and social well-being. But before really diving deep into the answer of the question, I think it's good to start by refreshing the GRI definition of materiality based on GRI Standards materiality principle. And it states that the report shall cover topics that reflect the reporting organization's significant economic, environmental, and social impacts, or substantively influence the assessments and decision of stakeholders. This being a broad group of stakeholders like business, labor, civil society, capital markets, governments, etc. And to apply the materiality principle, it is required to identify material topics based on these two dimensions. An organization is faced with a wide range of topics on which it can report, and relevant topics which potentially merit inclusion in the report are those that can reasonably be considered important for reflecting the organization's economic, environmental, and social impacts, or influencing decisions of stakeholders. And in this context, impact refers to the effect an organization has on the economy, environment, or society. And this impact can be positive or negative. In sustainability reporting, materiality is the principle that determines which topics are relevant and sufficiently important to report on them. GRI standards are kept broad intentionally and include many issues spanning around these three themes, economic, environmental, and social. And stakeholder engagement and materiality are at the core of applying the GRI standards. Next slide, please. Yes, thank you. Here you can see an overview of the scope of the GRI standards and its application. Not all the topics are of equal importance to all organizations and their stakeholders. Applying the materiality ensures that organizations use the relevant topics out of all the topics included in the GRI standards. And this brings us to the question, should we only focus on ESG issues that are financially material? And what we see is that the movement to limit corporate disclosure on environmental, social, and governance issues to financial material topics has gained some momentum. And while financially materiality is an important perspective, it is a subset of the larger and equally important perspective of stakeholders beyond shareholders. And we know that investors are demanding ESG information. Both Colette and Robert addressed this. It becomes more critical to investors and free trade, but we cannot solely rely on the test of financial materiality. These issues are very hard to monetize. Let's take for an example, ethics, gender diversity, scope 2 and 3, carbon, water. Many of these issues are not just financial material, and yet we know they are absolutely critical. And also, please keep in mind, what is not financial material today can be tomorrow. For example, labor issues in your supply chain can become financial material when they reach the front page of the Financial Times. And what GRI tries to do is to help companies to report on the full range of impacts on company and the world around it. And therefore, the GRI definition of materiality requires business to go beyond an internal focus on financial impact of the company itself and requires them to consider their social, environmental, and economic impact on the wider world. The majority of companies disclosing ESG information use the GRI standards. And currently, the GRI standards are referenced in over 160 policies around the world, more than 63 countries. And what's really surprising is that 45% of those disclosure of these policies, are capital market regulations. And just last October, just before the conference, WBCSD launched their annual report, and it states that 87% of the 159 reports reviewed use the GRI standards. Next slide, please. Another concept that I would like to discuss today is how to define impacts. That is a core concept that also generates some confusion. In the GRI standard, impact refers to the effect an organization has on the economy, environment, and or society, which in turn can indicate its contribution, positive or negative, to sustainable development. Therefore, reporters need to avoid reporting only on positive impacts and report both on positive and negative impacts. In the GRI Standards, the term impact can refer to positive, negative, actual, potential, direct, indirect, short-term, long-term, intended or unintended impacts. And if in exceptional cases an organization preparing a sustainability report in accordance with GRI standards cannot report on a required disclosure, the organization shall provide in the report a reason for omission that describes the specific information that has been omitted and specifies one of the reasons for omission, as you can see here in Table 2. Impacts on the economy, environment, and/or society can be related to consequences for the organization itself. For example, an impact on the environment, such as GHG emission, can lead to consequences for organizations' business model and reputation or ability to achieve its objectives. For instance, due to climate-related catastrophes such as floods or storms, they can have an impact on the operations, for example, the availability of resources. But the consequences for the organization are not the focus of the reporting activity based on the GRI standards. Focusing on materiality means your reporting practice will help you understand the context and implication of your activities. It will create awareness of your significant impacts on society and environment and play a role in helping you to manage those impacts for the better. For example, the identification of potential risks, thus improvement in terms of risk management. Ultimately, it is about reporting on those topics where you are creating significant impacts. And it's crucial to do a good job when defining these topics for a report. And this is where materiality comes in. Reporting on material issues means reporting on impacts. The real deal makers or breakers when it comes to your company's behavior and reputation and the decision of your stakeholders. And there, a long-term view is essential. An issue that is not material now might become material in the future. Next slide, please. Responsible business practices attract sustainable finance, ensuring a virtuous cycle in the flow of goods, services, and capital that can benefit other stakeholders and the natural environment. And it's also well established that both investors and companies benefit from meaningful disclosures on sustainability performance and impact. Sustainability data can bring business value creation. And what you can say here is what you cannot measure, you cannot change. And for us, the end goal is not to get more people to report, but to get the disclosed data to be useful to inform management and investment decisions. And that was it for me today.
Yeah, excellent, Sabine. Thank you very much. I mean, this is so important. Consistent and comparable company data, ESG data, is absolutely critical for a highly efficiently functioning capital market. And GRI has an extremely important role to play in defining and evolving around the question, what should we really be measuring? And I think you guys you've done an excellent job at demonstrating that in this presentation. So really focusing on what is material to your stakeholders across all stakeholder groups and disclosing accordingly.
Thanks.
We have a question that I think might be interesting for you to have a look at. It is from Stefan, and he asked a question. So he is a sustainability consultant, and he says he often sees clients being bombarded with ESG questionnaires from different analysts and investors that totally disregard the materiality principle, or maybe even expanding on that question, or disagree on what is material for a particular company. But the end result is they are expected to report on a large number of topics, even if it's not deemed material by them. So do you have any kind of perspective or advice for these types of companies on how they should resolve this issue?
Thanks for the question. It's not an easy question because it goes back to the presentation I've given. And the slide we had before, it is ultimately not about the report, but about the journey you're taking as an organization. The report is a outcome of making a report with the GRI standards. It's important on one hand for you as an organization to really understand which topics are material for your organization. That is one. And yes, there is the continuous growing demand for from investors and from stakeholders to get information which they feel is material. What we see is that companies have different versions of a sustainability report for a specific audience. So they might have a different report for their shareholders, for their employees, and that is what we see, that a company uses the same information and presents it in a different way to be better adjusted to the audience.
Yeah, and there's another one that is somewhat related, I would say. And this one is from the risk perspective. Marianne says, I think any sustainability area that bears risk or potential risk to operations or reputation is financially potentially material, which yes, I would agree. Is risk somehow quantified, or I would even expand upon that to say incorporated in any way into GRI, or is that risk assessment something that is for the investors and the company to define for themselves?
Also not an easy question. Yes, as I just mentioned, something that is not financially material today can become financially material tomorrow, and therefore is a risk issue. In our standards in the 200 series, all economic disclosures are made. That's where we see organizations looking for risk. Is it specifically managed on risk? Not really, but what we see is that companies use all the topic-specific standards to see where their risk is, and I think that is a step before it, which is important.
Yeah, agree. Fantastic. Okay, well, I'm also conscious of time, so I would like to thank you very much, Sabine, again, and move to our next speaker, who is Hilde Nordbø. She is the Sustainability Manager at DNB Bank. They are one of the leading Norwegian investment banks. May I hand over to you, Hilde?
Thank you very much, Andrea. Thank you very much for inviting us to the session and repeating what we did in October. So I will talk very briefly about how we work in DNB with ESG metrics, and taking a little bit more holistic view and also integrating some of the things that Sabine mentioned. So just first of all, and to avoid any misunderstandings, I come from the Norwegian bank DNB, and it's not the Dutch central bank, but DNB is partly owned by the Norwegian state by 34%, but we are not the central bank. So I will briefly present how we work with metrics in DNB and what has been some of our success factors when it comes to integrating them. And the very short answer to the question is that we have to measure what matters and what is it that creates long-term value for all our different stakeholders that also Sabine touched upon. So the really tricky part is, of course, then how do we do this and how do we identify these topics and implement them in a complex organization where conflicting interests can be an issue or is an issue. But let's start at the end point for us in DNB. As you can see on the slide now, the most important part of our work on ESG metrics has been to connect them to an overall strategy that a large part of the organization can relate to and find relevant for their daily work. Because in order for the ESG to be truly integrated, we need the entire organization on board. What we did was that we started with the materiality analysis based on the GRI methodology, but we also then afterwards identified 4 overarching areas that are closely connected to our strategy. And as you can see, these areas seem very obvious for a bank, And this is actually kind of the point, because we don't need or want ESG to be something that is on the side and that the entire bank cannot relate to. And also the 4 themes are of course then also in line with our financial goals and also have relevance to a larger or smaller degree for all the different business units in the bank. Because this means then in sum that the entire organization is delivering on the sustainability strategy. And having these overarching themes makes it easier for us to focus on fewer topics, the material ones, and on the ones that are closest to the core business. So they make us prioritize actions, customers, and measures that contribute to any of these 4 themes. It's also important to mention that these 4 themes that are very overarching and also quite obvious, they're also accompanied by underlying concrete long-term ambitions that also Colette showed that they also have examples on. And these ambitions are also then relevant for the entire organization. So for instance, within sustainable finance, we have expressed that we will contribute with 450 billion Norwegian kroner, that's about 45 billion euros, to finance renewable energy up until 2025. And we also have ambitions when it comes to gender and equality, where the ambition is to have a gender balance in the bank that is 40-60 on management level 1 to 4. So again, all these ambitions are also then relevant for the entire organization, but the different business units are followed up on related ESG metrics. And one really important success factor for us has been that we work in the sustainability team closely with group finance and corporate governance team to make sure that the metrics and ambitions are anchored in the line. Because it is really key that the corporate governance follow up on the metrics and targets in the same way that they do on the financial metrics. Because little will really happen if the work on these ambitions and the ESG metrics is something that only the sustainability team and people are concerned with. So if you can click on the next slide, please. On the next slide, please. Then you will see an example of how we have integrated ESG metrics. So this is a slide from our most recent Capital Markets Day, where we for the first time integrated ESG metrics and long-term ambitions in some of our slides to show the investors how we are delivering on sustainability and have concrete measures when it comes to ESG. So lesson number 2 for us has been that we have metrics that can be connected, and they have to be connected to our company's overall strategy and thoroughly integrated and anchored in the line functions as well. And getting back to the actual metrics and how we do this, because that is the really tricky part. How can we identify the material ones? And then the GRI framework comes really handy. And I guess that some of you are very familiar with that, and maybe some of the other ones as well, because there are many frameworks out there. So from a sustainability point of view, we know that the GRI standards are the ones most recognized and widely used, and also the one that has gotten the most traction. And personally, I've worked with the GRI within assurance as an advisor, and now also when we try to internalize and integrate ESG. And we experienced that the GRI standard has its limitations. So in the search for good metrics, we also saw that using the best from the different frameworks is actually what has been very useful for us. So we have taken the best from GRI, but also looked to SASB, Sustainability Accountants Standards Board, and also the integrated reporting framework. And what we've seen and experienced is that using existing frameworks adds to the credibility of the deliveries from the sustainability team, and has also proven useful when communicating with investors and other stakeholders. Because as more and more research points to the positive relationship between high performance on material ESG issues and superior financial performance, we need to assure all stakeholders we are in fact focusing on the material issues and identifying them using recognized and assured methodology. So by working on integrating the ESG metrics, we believe that we can increase trust among our different stakeholders and be very specific with regards to our contribution to the change we need in order to reach the Paris Agreement and the SDGs. but also to uphold and build trust with our different stakeholders and remain profitable in the future. And as more and more investors and analysts are using rating agencies to evaluate companies' ESG performance, we also see a difference in the methods and often resulting in conflicting results. So we also believe that this increases the need for us to focus on what we, in relation with our business model and strategy, see as our most material issues, and make sure that we communicate on them and report on them. This also makes it easier for us to explain why we have omitted certain issues based on the materiality analysis. So our goal is not to produce more metrics, but rather to align our strategy with our most material topics. So we make sure that the core functions of the organization are on board, and by being change agents, we can push the organization to integrate ESG in the already existing reporting lines and corporate governance structures. So thank you very much. That was all I had to share at this point.
Fantastic. Thank you for this insight, Hilde. It's really important to hear this story from a corporate. We've had a lot of investors and frameworks so far, but you as a bank have a very unique lens on this, because in addition to your corporate activities, you are also exposed to downstream ESG risks and opportunities through your financing activities. So it will be very interesting to see how banks across the world integrate ESG into their core businesses and actually assess companies for their lending portfolios based on ESG criteria, etc. So I will since that was our last presentation, I'd like to turn back to some of the questions. And I'd like to start with Robert. So the first one is, when used in isolations, metrics only tell a small part of the story. So Robert, how do you frame or contextualize the ESG indicators to make them more useful to your investment process?
Thank you for this question. It's a really important one. There are many aspects we should take into consideration when we contextualize ESG indicators. There are industry specificity, company maturity, and so on. But I would like to underline the importance of integration financial data and ESG data. First of all, at Abris, we don't do ESG due diligence or ESG analysis as an isolated process or separated from the other investment activities. For example, ESG due diligence, ESG monitoring, ESG value creation are integral part of the investment process. Of course, ESG indicators are useful to some extent, but we do not analyze them for themselves. As I said, we have set of ESG indicators, but they are helpful if we do ESG analysis from the point of view of the investment perspective. For example, I assess environmental data differently in case in which our goal is to increase production capacity, differently if our goal is to build a new factory or change the manufacturer product. Another example, I analyze corruption risk differently in the case in which we have a plan to develop sales in countries with high level risk, corruption risk, or if we work with the large number of brokers. That's why I try to engage in ESG due diligence process. Consultants, of course, can identify ESG risk, but not always are able to deliver us comprehensive view without knowledge of investment hypothesis. And to sum up, ESG indicators are useful if they are integrated with process and not treated separately.
Yeah, understand. That's great. So you really need to make it an engaging process and actually analyze the data differently as needed and as per sector, per scenario. So that's very important that you do that.
Exactly.
The next question I have is quite similar. It's for Colette. I would like to, from the Robert on the private equity side, you more on the listed equity side. How do you guys do this with such big data sets? Robert has quite a small portfolio. On the listed side, you have thousands of companies to basically choose from. How do you guys do this differently?
Yeah, great question. I think indeed, as you said, given the size that we have to assess, we have to make choices of what we put our focus on. And depending on which bucket of companies that we're evaluating, so are we evaluating based on norms and ethical principles, we have a different approach, because those that will be done on all companies. And we use external providers that actually collect all kinds of information from annual reports, from publicly available information, from news reports, from NGO reports, to actually come to a final judgment on whether companies are crossing the boundaries or not. And then when it comes to, for example, assessing impacts, we also have to make a selection. So usually what our process looks like is that we use a quantitative screening at first to make a certain selection based on the type of sustainability aspects that we find relevant, as well as the thresholds that we think should be met for certain for a certain sustainability label. And then after that, we evaluate whether we have additional information to make sure that actually these companies fall within a certain bucket. So I can give an example for one of our products, which is really global, which is called Global Listed Equity. We have a very thorough process. So next to the quantitative information, we use a framework where we actually assess, based on the reports that we receive, whether a company is actually contributing to the SDGs, and whether also they're not crossing any planetary boundaries with their operations, for example, or across other activities that they are exposed to. So it's a very complex way of analyzing, but given the size, we often take a first selection based on a quantitative information and highlight then those issues where we have some doubts with more qualitative information.
Yeah, understand. Thank you for that. Next, I'd like to actually go back to Sabine at GRI, and around the question of what we should be measuring. I mean, GRI has such an important role to play in this discussion because basically they set the framework for what gets reported. So my question then to Sabine is how does GRI actually go about setting the indicators? How do you guys as an organization define what should be measured?
Thanks, Andrea. That indeed is an interesting question, and it also straight away becomes quite an technical answer. Just to provide a brief historical overview, GRI has been around since '97, but in 2016 we've had a very important evolution, is that we transitioned to standards. So we used to be a guideline, with the last guideline being G4, and in 2016 we became a standard. So now we are a standard setter. We have an external global sustainability standards board, and they are the independent standard setting body created by GRI. And it is quite a formal process with a due process protocol, with a due process oversight committee. It's really technical, but it is essentially the GSSB who decides what indicators are in the standards and which one are going to be developed. Like recently we have developed a tax standard that has been put on the agenda by our GSSB, who are informed by reporters, by all the stakeholders in the GSSB, because that's also a multi-stakeholder board. It's global, so it is the GSSB who makes the agenda, and the agenda is always quite transparent, and it's on our website. You can look for the work program and standards review, and the next standards to be updated are the human rights one, the universal standard, waste, and we're now working also on the development of the sector standard for oil, gas and coal. So that's also quite an interesting one. And also what GRI looks at is how we can really help organizations to show how they are contributing to the SDGs. And that's also something what I just wanted to touch upon on the previous speakers. The GRI standards can be linked to them. If you look to the analysis of goals and targets that we made with the United Nations Global Compact, you can really see how the GRI standards can help you to show how you contribute to achieving the SDGs.
Excellent, excellent. So also in light of the question, what should we really be measuring? I'd like to come back to Hilde, because you mentioned offline that you are using the GRI materiality matrix to help you identify the different ESG aspects that your stakeholder groups find most important. Can you explain in more detail what this engagement process actually looks like? How do you actually end up with a finalized materiality matrix?
Yeah, sure.
And do these outcomes actually surprise you?
Yeah, of course. This is also a very a big question because it's a quite complex process. But again, we think that the GRI methodology gives a quite useful insight into how the process can be done. And it is, of course, a very important part of our stakeholder engagement. So what we do is that every second year, we do quite a thorough process where we both use qualitative and quantitative data, where we talk to our stakeholders, we interview them, and we meet with them. But we also do like a desktop analysis. And the starting point for the conversation with the stakeholders, once they are identified, is actually the SASB framework and the industry benchmark that they have, because then we also at least have somewhere to start. We use industry standards for both financials, but also for technology and communications, because as a bank, I guess many of you know, we're also a technology company these days. So every second year we do quite then a big analysis, but then we also do like smaller ones to make sure that we are on track with the expectations from the different stakeholders annually as well. And what we find is that most of the time we are maybe in line with what they expect, but the insight is also very useful to share across the bank. So having meetings with people in the bank who not usually maybe meet NGOs or other types of stakeholders is also a very useful tool for us to kind of share the knowledge that they provide to us into the actual matrix.
Yeah, okay, super, thank you. So we're running toward the end, so I think this will have to be our last question, but I'll actually put it just open, maybe starting with Colette, and I'd invite everyone else to also chip in if there's time. But Colette, in your opinion, to what extent do you think that investors and rating agencies of the sort should be taking into consideration policies as opposed to other non-formal pieces of evidence of corporate sustainability action? So basically hard evidence and antidotal evidence versus the kind of governance element of a policy.
Great question. I think we need both for sure, because without policies, it's very difficult to assess what the intent or what the long-term commitment of certain companies to certain topics is. At the same time, it's only words on paper, so we need proof to provide us with a real feel of how the companies are implementing these policies. And I agree that currently the quality of that data on implementation is still in development, and especially in the impact realm, we're definitely not there yet, but it can definitely be a starting point for a conversation or an engagement with a company on certain topics as well.
Does anyone else have any kind of elements to add to that? Robert, what do you see? I mean, especially with this kind of smaller organizations that you work with in the private equity space, how much weight do you think you should be giving them in terms of antidotal proof versus you must have a policy or something similar?
Oh, for sure, both. Policy is important because it creates fundament for achieving the goals in the future. So if we have policy, it's a good starting point. But what is important is to implement ESG to this strategy and monitor the progress of this strategy. So without measure, what get measured is done. So if we can measure something, we can improve our value or mitigate risks.
Yeah, Yeah, excellent. I think that's the theme. What it gets measured gets done. I heard it somewhere else today as well. I think, Sabine. Well, we are at the top of the hour, so we will have to close down. But it was a fantastic discussion, and thank you all very much for tuning in today. We hope to have you around next time as well. So thank you very much.
Thank you, Andrea, and thank you to the other speakers. It's been a great discussion, and we've had a lot of questions coming through. And it's my pleasure to be able to have you all join us again and share your insights on such an important topic. Just to confirm, the webinar recordings will be sent to everyone at the end of this week. This webinar was part of the Knowledge Exchange, as you will see here, as my team have displayed in the build-up to next year's Responsible Business Summit in 2020. This is one of the key topics that we'll be looking to address. And yes, a key theme, or the main theme of the event, is how can we lead the decade of action? And unfortunately, over the past few days, it's increasingly evident that business, NGOs, investors, and other key associations are going to have to be the catalysts to deliver the new blueprint of business. And it's going to be a really ambitious event, and one that we're really excited for. So if you are interested in finding out more information about that, do visit ethicalcorp.com/RBS. That marketing plug is now over. So just want to just say thank you once again to Andrea, Robert, Colette, Sabine, and Hilde. Really insightful and interesting to hear you again present on such an important topic, and thank you for your time once again and your preparation that went into this. And that's it for me. I'd like to wish everyone a wonderful and relaxing festive break, and until the next time, all the very best. Thank you very much.